Thank you for joining us today for our weekly investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we're going to start as we always do with our chart of the week. And this one I wanted to spotlight the valuation difference between international markets and the US market. So we get these charts from JP Morgan's Guide to the Markets. It's a good resource that we have access to. And looking over here on the left, what you can see is the range of price to earnings ratios for the different major regions of the world over the last 20 years. And the diamonds, kind of the purple diamonds particularly, show where we currently are on a price to earnings ratio basis. And you can see here at the far left that the US is up near the top of its valuation that it's seen over the last 20 years. And it's well above its historical average level of valuation. And you can see that in the kind of sideways lighter gray bar. And when you look at the other regions, you can see that they're generally more expensive than their historical medians, but not by nearly as much as the US. And you can see that they are far less expensive than the US market relatively. Now, some people would argue that there's a difference in sector composition, so the US should be more expensive. The United States market is predominantly tech and communications, which are more heavily growth oriented than some of these other regions. But when we look at the valuation of the different sectors, and you can look at that on the right chart here, you look at the valuation difference of the different sectors versus the US, and you can see that all sectors, all 11 sectors are cheaper for international markets than the US market. So, for instance, international technology is over 30% cheaper in the international markets than the US market. So, when we adjust this for sector composition, we can still see that a huge valuation difference is present. And that has been supportive of this run of international outperformance this year. And that's what we're showing here when we take a look at asset class returns year to date. You can see that emerging markets and developed international markets are both up about mid 20s% this year. The US has done well. The S&P 500 is up 14%, and small cap stocks are up 10%. So both of those have done well, just not quite as well as the international markets. Now, commodities and bonds have also performed well this year, and the dollar has been weak, and that has supported some of these trends, especially the international strength as well. Now, looking at the economic data that we got from last year, we got an update on the S&P Global Purchasing Manager Index. And we can see here in the top that combines both the services and the manufacturing sector. And you can see that it ticked down a little bit in its last update. Still, 53.6 is a healthy reading. The economy is in expansion, but it does look like the expansion is slowing somewhat. And that's in line with our expectation for the next quarter or two that you're going to get some softer economic growth. Now, new home sales was a bright spot in the data last week. We can see here that the 1 month change in the middle clip of new home sales was up 20.5%. So that was a really strong bounce back in new home sales. And you can kind of take a look and see that there's been a benefit to lower mortgage rates and also some builder incentives. So when we look at what's going on with new homes, we saw a good pop there, and they're responding almost immediately to a lower mortgage rate. So that's a good sign for the broad economy. Now, we also got an update on inflation last week. The Fed's favored PCE inflation and core PCE, which strips out food and energy because they tend to be volatile categories, ended up 2.9% year over year. And when you decompose that out, you can see here we're showing services PCE, which is the darker blue in the top. We're showing housing inflation in the middle, and we're showing goods inflation in the bottom clip. And you can see that housing inflation has been moderating. It's still running higher than pre-pandemic, And services inflation has been sticky, but also moderating some. The big difference here in this year is that goods inflation has started to turn higher. And we can see that from the global financial crisis in 2009 to the pandemic, goods inflation was reliably negative. Then we got the pop in the pandemic, and then it became negative again. Well, this looks to be a pretty direct tariff impact, bringing goods inflation back into positive territory, and that's keeping inflation somewhat sticky, perhaps complicating the Fed's path from here. That said, the rate cut was justified when we think about what's going on with the labor market. So this chart here shows in the middle clip, it shows the unemployment rate in orange, and it shows an estimate of what the steady state unemployment rate would be for the economy that's neither too hot nor too cold. So the estimate for steady state unemployment is 4.3%. The unemployment rate today is 4.3%. So that has normalized through time. And now you have more of a balanced labor market, which supports a more neutral policy setting. Now, when we look at the bull market, the cyclical bull market remains well intact. And what's been driving it has been some really strong demand for US stocks. So, in the bottom clip of this chart in orange, we're showing the 4-week total of flows into domestic equity ETFs. And you can see that amount of flows has been positive and about as high as it's been in 6 to 9 months. So you definitely have had money coming in, purchasing US stocks, and that has supported the cyclical bull market. And what we're seeing here from a leadership perspective is more cyclical sectors like consumer discretionary, technology, financials have been leading the advance, whereas the defensive sectors like consumer staples, healthcare, utilities, and telecom have been lagging in this advance. And that is a sign of healthy risk appetite in the market. For now, cyclical leadership is a tailwind. And another thing that's been encouraging more recently was small caps starting to break out and get in on the action. So the Russell 2000 finally made a new all-time high at the beginning of last week before correcting a little bit as the week went on. And small caps don't necessarily need to be the top performing asset class, but we do want to see small cap stocks participating in the advance. And that's what we've been getting in recent weeks and months. And that's been a positive sign for the sustainability of the bull market. Now, that said, the secular bull market, which comprises potentially decades of time, does look quite stretched to us. So we can see here in the top clip that since the secular bull market got started at the low of the global financial crisis, the market's returned 13.4% per annum, and that's not even inclusive of dividends. But the bottom clip shows that market value as it relates to net worth is stretched to essentially an all-time high here. So that tells us that the market has gone really far relative to the net worth that can support those stock prices. And that's a bit of a warning sign to us that the longer term secular trend is quite stretched here and something to pay attention to. And another way to show that is in US household allocations to stocks. So this top clip in this chart in blue shows that stocks are now about a 2/3 weight in household allocation, and that compares to an average weight of just under 49%. So households are clearly well allocated to stocks, and historically that has been a warning sign that the secular trend is quite stretched. That said, we don't want to be alarmist over the next year of returns just because valuations are high or market value is high relative to net worth. We can see here in this chart that your price to earnings ratio has almost no relationship with your future 1-year returns. Now, it does have a pretty strong relationship with 10-year returns, But 1 year returns has a very weak relationship, and that's what an R squared of 4% tells us is almost zero relationship between your starting price to earnings ratio and your returns over the next 1 year. So that's what we have, our closing thoughts for the week. When we look at our chart of the week, international stocks do appear relatively attractive even after this strong run that they've had so far this year in comparison to US stocks. And that is true when you adjust for their own market history and then also differences in sector composition. Now, economic growth has been resilient, but it is moderating, and we expect some softer but still positive economic growth over the next quarter or two. Now, the resumption of the rate cutting cycle looks like it was justified by easing economic growth and some modest labor market deterioration. Now, a good outcome has been the housing market, especially new homes, almost immediately responding to lower mortgage rates. However, inflation has been sticky, and tariffs are starting to drive up goods inflation, which is contributing to that stickiness. And that does somewhat complicate the future path of interest rates here. Now, the cyclical bull market is certainly well intact, and it's been driven by strong demand for stocks and cyclical stock leadership. But the long term secular trend is stretched, and that's something for us to be cognizant of. That's what we have for you today. And as always, I want to thank you for joining us and wish you a terrific week ahead.